What's happening, everybody? I'm Tyler and welcome to the channel. Today I wanted to make a video about call options and for beginners, and I'm going to make it real simple and a little less daunting for you guys. And just want to let you guys know, you don't have to know all these terms. You don't have to know the intrinsic and extrinsic value to trade options. There's just some basic things that you need to know to make money on options, and I'm going to show you how you can make crazy profits on options. So to do that, first we need to look at some definitions. So a call option. What is a call option? It is the right but not the obligation to buy shares at a set price, or the strike. So what is the strike price? The strike price is the price at which you can buy the shares, 100 per contract, if you choose to exercise the option. Then we need to know the premium. The premium is the price you pay per share for the option. For example, an 86-cent option times 100 equals $86. So why do we multiply by 100? We multiply by 100 because each option contract is for 100 shares of the stock. So we take the price and multiply by 100 or move the decimal point 2 places to the right. So for example, the premium or the price of the contract is 85 cents times 100. So the premium is $85. The premium is 85 cents per share, and since each contract is for 100 shares, we will multiply by 100. Then we need to know the expiration, the date the contract expires, and you must choose to either exercise or sell the option. And then the Greeks, the delta, the gamma, and the theta. So the Greeks are really important, and this are things that you definitely need to know before you make any trade on an option. So the delta is the change in value of the contract if the stock price rises $1. So for example, a stock that's trading for $10 and the option has a delta of 25 cents, and we would multiply that by 100, that's $25. So if the stock goes from $10 to $11, your contract is now worth $25 more. The gamma. The gamma is the change in delta after the stock rises $1. For example, the stock rises to $12 from $10 and you have a delta of 25 cents times 100. That's $25. And a gamma of 5 cents times 100. And that's $5. Then your contract will be worth $55 more. The first dollar rise in the stock valued the contract's worth 25 greater. The second dollar rise, the gamma added, increasing the value to $30, giving you a $55 profit. And then the theta. The theta is really important because of the time decay, the daily cost of owning the contract. For example, a theta of 0.09 times 100 is $9. So it costs you $9 a day to hold the contract. And an important note is a contract that's closer to expiration can have a higher theta than the delta, which is bad as your likelihood of the option being profitable is slim. And then you have two types of call options that you need to know. The first one is in the money, and in the money is if the stock price is already above the strike price. This is known as an in the money call option. For example, if we buy a call option with a strike price of $7.50 and the stock is trading at $10, this would be an in the money call option, as we are already trading over the strike price. Pros of in the money options is a greater delta and less time decay. However, since the premium is higher, if the stock price goes the wrong way, our losses are greater. And second, we have an out of the money call option. An out of the money is if the stock price is below the strike price. This is known as an out of the money call option. For example, if we buy a call option with a strike price of $10 and the stock is trading at $7.50, this is an out of the money call. The pros of an out of money call option is the lower cost per contract, giving you the greater leverage if we see a move in our favor. However, the out-of-the-money options have lower deltas and a greater risk of time decay. So I know exactly what you guys are thinking. That was a lot of definitions really fast, but that's okay because we're going to go ahead and visualize all those definitions and pull up an options chain. So I have the options chain for NNDM pulled up, and if you have Thinkorswim, it will be under the Trade tab. So let's go ahead and go to the April 16th options. And another thing to note on options is you always want to go further out than you need to. So I usually try to go 90 days out because that'll give you plenty of time. If the stock doesn't do what you expected it to do, it'll give you plenty of time to make your money back. Okay, so if we go ahead and look here, the first thing that we're going to see right here is the expiration dates. The next thing we're going to see is the strike prices, and then the ask and the bid, the change, and the last. So the ask is going to be the price you're going to pay per contract, right? And we're going to multiply by 100. So the ask is $4.25 times 100 shares, that's $425. For a $7.50 strike price. So this is a call option for a $7.50 strike price with a $425 premium. And you can go to layout here for your delta, gamma, and theta. And also these highlighted in blue are the in the money options, and these are the out of the money options. So the in the money options are safer and have a higher delta, and the out of the money options are cheaper with a lower delta, but it gives you more leverage. Okay, so the next thing that we're going to want to look at will be the delta, the gamma, and the theta. So if you go to the layout tab and change it to delta, gamma, and theta, we can see that the delta for this is 87, which times 100 is $87. The gamma is 4 times 100 is $4, and the theta is 2 times 100 is $2. So if this stock goes from $11.31 to $12.31, and we buy this $7.50 strike here, we'll make $87 profit. But if it goes up to $13.31, so a $2 rise, you'll make $87 plus $87 and then add 4. So you're looking at $178 profit on a $425 option, and it only went up $2. So you can make 40%, but the stock didn't even rise that much. So that's why options are really beneficial, because of the gains that you can make with the money that you spend. But it's also important to note, like I said, that I would probably buy a contract further out. I have a position for the March 19th expiration, but I bought that 3 months ago. So you always want to give yourself plenty of time for the expiration, right? And the reason that I would buy one of these closer to out of the money is because I could buy 2 contracts for $316, and they would be less, and my delta would still be higher, right? I'm spending less money, but I have a higher delta because the price is less. So this delta would be $100 as opposed to $87, and I would actually spend $100 less, which is why, closer to the in the money calls are really beneficial and is what I like to use. And we can also see in the today's option statistics tab the total trade analysis, so you can see the total calls bought, and the market's closed and it's Sunday, so this will actually be for Friday. So on Friday there were 50,000 calls bought and 12,000 puts. So the odds are in your favor, right? More people think that the stock is going to rise than fall, which is a good thing. And on Thinkorswim, we'll also see on the layout tab, you can also see other things. So you can see implied volatility, probability of out of the money, delta, position, intrinsic and extrinsic value, which I don't want to get into for beginners because that kind of makes everything kind of confusing. So let's go ahead and look at probability of out of the money. So on these April 16th calls, you can see your probability of out of the money on the in the money call options are lower, so your probability of losing money is lower. Whereas if we go to the out of the money call options, this has an 80% probability that you will close out of the money. So this is 80% probability that you will lose your money. So right now we're looking at the options chain on NNDM, and I chose to talk about this one because it's not really a loaded options chain and it's a little easier to explain. But if we look at like Tesla, we can see that it has a loaded options chain, right? There's way more options for that, and a lot of stocks are like this. One that I've made recent trades on is SOS. It has a loaded options chain. So some have more options than others, and also the weeklies. These expire every Thursday and gives you a chance to trade on a weekly basis, whereas your delta, your theta won't be so high and your delta will still be higher, but it's also a weekly contract, right? So I'll get more into that in another video and explain that a little better. But for now, I wouldn't take a weekly options trade if you don't know exactly what it is. Just stick with the monthlies. And since we like to use all the resources we have available to trade, for options you have an options profit calculator, and if you go to Google and just type in that options profit calculator, it'll pull up this website, and we go to long call bullish and type the ticker symbol, which is NNDM, and then we can select option. So we were talking about the April 16th $7.50 strike, and then we can go to calculate. And what I always like to do is come up here and broaden our range. So we can type in $20 and calculate. So as we can see here, it gives you the dates and the prices. So if NNDM went to, say, $13 on Monday, then you would make $144 or 33.9% profit. And as you can see, because of the theta, it goes down a little bit every day. But you'll still, as long as NNDM is $12 by the expiration date, we'll still make $25, right? So not bad. But from this graph right here, you can see how much money is possible to make on options. You know, if NNDM experiences some really good news, everybody's kind of waiting on a buyout news from them, because that's what their CEO's trying to do, is get bought out. Say we get buyout news and then all of a sudden NNDM pops up to $16. Well, if it does that Monday, we make $432, and if it does it by our expiration, we'll make $425. So, I mean, not a bad trade, not a bad deal. This is why I love options, and I'll continue to talk about these and make videos about them to make it really simple for you guys, because I want all of us to make money, not just me. I want all of us to make money, and with this new stimulus package coming out, a lot of people are looking into making money in the market, and I'd like to help you guys do that. You know, you can make $100 trade on an option, and I've done this, and make $300, $400, $500. I did it a couple weeks ago on SOS. I think I made a $220 trade in options trade, and I ended up making 450% profit. So, I mean, it's really easy. It's really risky, too. You know, if it goes the wrong way, you could lose all your profits, which is why you want to get an expiration date further out. The further out, the better. I want to thank you guys for visiting the channel and watching the content that I have for you today. If you don't mind, please remember to like and subscribe. And also in the link down below, I've included a link to Webull where you can get started trading. And they have extended trading hours, and you can get 2 free stocks valued between $8 and $1,600. So sign up today and start this journey with us. I appreciate you watching, and everyone have a great day.